Certainty feels powerful. It feels intelligent. It feels safe. And in financial markets, it is one of the most dangerous emotional states an investor can experience. Most people believe that investing success comes from conviction. They assume the more certain you are, the better your results will be. They admire confidence. They follow strong opinions. They equate decisiveness with competence. But markets do not reward certainty. They reward calibration. There's a fundamental difference between confidence and certainty. Confidence acknowledges uncertainty. Certainty denies it. And denial in probabilistic systems is expensive. When an investor becomes certain, something subtle happens. Risk perception declines. Exposure increases. Flexibility disappears. The investor stops asking, "What if I'm wrong?" and starts assuming, "I am right." This shift is rarely dramatic. It doesn't feel reckless, and it feels justified, it feels informed, it feels like clarity. But clarity is often just the absence of acknowledged doubt. Markets are complex, adaptive systems. They respond to information, liquidity, sentiment, positioning, and expectations. Even when your thesis is fundamentally sound, outcomes can diverge for long periods of time. Certainty cannot tolerate divergence. It interprets divergence as error in the market, not in the position. This is where the hidden cost begins. When certainty meets volatility, it does not reduce exposure. It defends exposure. It adds to exposure and it doubles down, not always aggressively, sometimes gradually, sometimes subtly, but always with conviction. The investor tells themselves, the market will correct. This is temporary. The fundamentals haven't changed. Sometimes that is true. Often it is not the relevant variable because markets do not move purely on fundamentals. They move on expectations, on positioning, on flows, on narrative shifts. Certainty narrows perception. It filters information selectively. Evidence that supports the thesis is amplified. Evidence that contradicts it is minimized. This is not stupidity. It is cognitive protection. The brain protects internal coherence. Admitting uncertainty feels destabilizing, so certainty preserves emotional stability, at least temporarily. But what it destroys is risk calibration. Certainty makes investors take positions that assume favorable outcomes. And when outcomes are unfavorable, the adjustment becomes painful. Now let's go deeper. Certainty is attractive because it reduces psychological tension. Uncertainty is uncomfortable. It creates cognitive load. It requires holding multiple possibilities in mind simultaneously. That is mentally exhausting. Certainty simplifies. It collapses probabilities into a single narrative. This will happen. And simplicity feels relieving. But financial reality does not collapse into single outcomes. It branches constantly in every direction. In bull markets, certainty grows quietly. Success reinforces belief. Profits validate narratives. Low volatility convinces participants that risk has disappeared. And when everyone begins to feel certain at the same time, something dangerous forms. Consensus concentration. When too many investors share the same certainty, positioning becomes crowded. Crowded positioning increases fragility. Fragility increases the speed of reversal. And reversals are most violent when certainty was highest. This is why market tops rarely feel uncertain. They feel obvious, they feel justified, they feel inevitable. And inevitability is the language of certainty. On the other side, market bottoms are full of doubt. Fear dominates, uncertainty is overwhelming. Confidence disappears. Ironically, those environments often offer the best long-term opportunities because uncertainty reduces exposure. Certainty increases it. Now let's connect this to modern markets. In an age of social media, certainty spreads faster than ever. Strong opinions attract attention. Nuance does not. Bold predictions go viral. Probabilistic thinking does not. The louder the certainty, the more engagement it receives, and engagement reinforces confidence. This creates an echo chamber of conviction. Investors consume content that confirms their beliefs. Algorithms amplify emotionally charged narratives, and the illusion of inevitability becomes stronger. But markets are indifferent to online consensus. They are indifferent to how convincing a thesis sounds. They respond to positioning and liquidity, not persuasion. Now consider another subtle cost of certainty. Certainty reduces learning. When you believe you're right, you stop updating. You stop observing objectively. You interpret new data as confirmation. You reinterpret negative evidence as temporary noise. This blocks feedback loops. Markets provide feedback continuously, but if certainty filters feedback, growth stops. Over time, rigid investors become fragile investors. Fragility in markets is dangerous because markets shift regimes. Volatility expands, liquidity contracts, narratives reverse, and rigid positions break under stress. Flexibility, on the other hand, compounds. Flexible investors scale exposure gradually. They reduce risk when volatility increases. They adjust when probabilities shift. They detach ego from outcome. They understand that being right is less important than staying solvent. Now let's make this deeply practical. How do you build resistance to certainty? First, define invalidation before entry. Not emotionally, structurally. At what price? Under what condition? With what fundamental change? Second, size positions as if your thesis has a meaningful probability of failure, because it does. Third, rehearse opposing scenarios. Force yourself to articulate the strongest version of the thesis you disagree with. Fourth, separate ego from exposure. Conviction should never determine size. Risk parameters should. Fifth, monitor emotional reaction to disagreement. If opposing views trigger irritation instead of curiosity, certainty is creeping in. The goal is not to eliminate conviction. It is to prevent conviction from eliminating flexibility. Remember this, certainty feels like strength, but strength in markets is adaptability. Certainty feels like intelligence. But intelligence in markets is probabilistic humility. Certainty feels like control. But control in markets is risk containment. The hidden cost of certainty is not immediate. It compounds quietly. It compounds through exposure, through rigidity, through delayed reaction. And when the environment shifts, the cost surfaces all at once. If you remember only 3 things from this video. First, certainty reduces perceived risk, but increases structural fragility. Second, flexibility protects capital more reliably than conviction. Third, survival requires managing uncertainty, not denying it. Markets do not reward how certain you sound. They reward how well you navigate what you cannot know.